How does a company keep its top-line revenue completely flat, yet manage to spike its core earnings by nearly 30%?
It's a great question, and it takes some serious financial engineering.
Right. Well, PG&E Corporation, ticker PCG, just delivered a remarkably strong internal earnings beat year over year for the second quarter of 2026.
And since our source material today doesn't give us the Wall Street consensus estimates or the post-market stock action.
Yeah, as retail investors, we are watching the tape incredibly closely right now to see how the market reacts to this fresh print. So here are the headline numbers you need to know right out of the gate.
Let's hear them.
Non-GAAP core EPS hit 40 cents a share. That is a really solid jump up from 31 cents a year ago. GAAP EPS came in at 33 cents,
Okay.
but total operating revenues were essentially stagnant. They came in at $5.9 billion.
Right. Flat revenue. And for guidance, the company reaffirmed its full year 2026 core EPS guidance of $1.64 to $1.66.
Yeah.
And perhaps most crucially, they reaffirmed this unprecedented $73 billion capital investment plan through 2030.
Which is massive. And that brings us to the mission for you, the retail investor listening to this deep dive.
Exactly.
We want to step back and cut through the noise of this specific earnings report. We are taking the raw filings, the management presentations, and just extracting what actually matters for your portfolio.
Because you simply do not get a 30% jump in core EPS on a flat revenue base without pulling some major levers underneath the hood.
Yeah, it's a bit of a riddle. So the obvious transition here is to look at the actual segment performance. Where is this cash coming from, if not from new sales?
Well, looking at the raw data, the electric revenue actually dipped slightly. It went down to $4.38 billion.
Oh, wow.
Yeah, and natural gas rose slightly to $1.51 billion. So, I mean, the revenue mix is incredibly stable, but it is certainly not growing.
So what were the margin drivers?
The real earnings power came from two very specific internal things: capital investments and, honestly, a ruthless approach to cost cutting.
Let's start with the capital investments. For anyone newer to utility stocks, let's just quickly define what the rate base actually is, because you kind of can't understand PG&E without it.
Right. So the rate base is essentially the total value of all the physical property and infrastructure that a utility is allowed to earn a profit on.
Authorized by the regulators, right?
Exactly. In this model, earnings are fundamentally tied to expanding that physical base. When they upgrade aging substations or, bury power lines to prevent fires, they don't just spend that money.
They get to earn a guaranteed margin on it.
Yes. They are authorized to earn a return on that deployed capital. And this quarter, those customer capital investments directly added 9 cents to the EPS year over year.
That's a huge chunk of the growth. But to fund that, they had to free up cash, which brings us to their operating and maintenance expenses, or O&M.
Yeah, the cost cutting.
It plummeted. It went from $2.86 billion a year ago down to $2.53 billion this quarter.
I mean, a reduction of over $300 million in operating overhead in a single quarter is just formidable.
It really is.
Management said they hit their target of a 2 to 4% non-fuel O&M reduction. But the critical piece is how they are using those savings.
Right. They aren't just hoarding the cash to make the quarter look good.
No, they are taking that liquidity and funneling it straight into fleet services and supply chain improvements.
I always like to visualize this with a homeowner analogy. Imagine you own a house with incredibly leaky pipes, right?
Okay, leaky pipes.
Every single month, you are paying a massive water bill for water you weren't even using. That's your bloated O&M expense.
Right, just money down the drain.
Literally. So what PG&E is doing is finally fixing the plumbing. They're spending significantly less on that wasted water.
But instead of just keeping that cash...
Exactly. They are redeploying it directly into pouring a stronger concrete foundation for the house. They are shifting cash flow from a sunk operating cost into a depreciable capital investment.
Which literally increases the authorized value of the property. And pushing that analogy even further, they aren't just pouring new concrete, they are negotiating better bulk rates on the cement itself.
The supply chain improvements.
Right. By driving down the day-to-day operating expenses, they manufacture the financial headroom they need to fund that $73 billion capital plan.
And they do it without completely breaking the back of the ratepayer.
Exactly. It's a highly deliberate margin expansion strategy.
Although there was a notable headwind in the regulatory filings we need to point out. It wasn't all smooth sailing.
Yeah, you always have to factor in the regulatory environment, especially in California.
Right.
The earnings growth from those capital investments was actually partially offset by a lower authorized return on equity from the CPUC.
The California Public Utilities Commission.
Yes, their authorized return on equity dropped from 10.28% down to 9.98% for the first half of 2026.
So walk us through the mechanics of that. Why does a regulator just suddenly lower the allowable profit margin by 30 basis points?
It typically comes down to these automated cost of capital adjustment mechanisms.
Okay.
Regulators are always trying to balance consumer protection with keeping the utility solvent. So when broader interest rates and bond yields fluctuate, the formula used by the CPUC flexes.
Oh, I see.
Yeah. If the formula says the utility's cost to borrow money has technically decreased, the regulator will lower the authorized return so the utility doesn't over-earn at the public's expense.
Okay, so the key takeaway for you, the retail investor, is that even with the regulator actively tightening the allowable profit margin, PG&E still delivered that 40-cent core EPS.
Because they aggressively managed their own internal operating costs.
Right, they pulled the levers they actually controlled to overcome the regulatory drag.
They basically engineered their way out of a margin squeeze.
Which sets up a really fascinating question about the long-term growth story. Cost-cutting is a great defensive play, sure.
Clean balance sheet, better near-term margins.
But investors buy utilities for predictable, regulated top-line growth over decades. You can only cut operating costs so far before you hit bone.
Exactly.
So where is the actual future demand coming from? Reading through the presentation, management points the finger squarely at AI and data centers.
Yeah, connecting this to the broader macroeconomic picture, the entire utility sector is undergoing this sweeping re-rating based entirely on projected AI energy demands.
And PG&E sits right at the epicenter of the global tech industry.
They do. In this report, management revealed a staggering 12-gigawatt pipeline of new data center projects in their service area alone.
We have to pause on that number. 12 gigawatts is almost hard to conceptualize.
It is.
To put it in perspective, 1 gigawatt roughly powers a mid-sized city. We're talking about the continuous power output of maybe a dozen large nuclear reactors just sitting in the pipeline for data centers.
The scale is monumental. The filings note these projects are advancing from their 2026 cluster study into the large load pipeline.
Explain a cluster study real quick.
Sure. It's how the grid operator group's interconnection requests together to see the localized impact on transmission infrastructure.
So this isn't just a vague wish list from tech CEOs.
No, it is a formal, studied queue of industrial demand. And this plays directly into this management initiative they're calling the Path to Flat.
Path to flat, meaning residential customer bills.
Right. One of the biggest political hurdles for PG&E has been customer affordability. California retail rates are notoriously high.
Very high.
But management explicitly stated in this print that with appropriate pricing, every 1 gigawatt of new data center load could actually save residential customers 1% or more on their monthly electric bill.
Walk us through the math on that. How does plugging in a massive power-hungry data center down the street actively lower the bill for a normal family?
It relies entirely on the ratio of fixed costs to variable costs. The physical grid, the high voltage lines, the substations, the vegetation management, that's all fixed overhead.
And right now, that burden is split among the existing customers.
Exactly, but data centers run 24 hours a day, 7 days a week. They provide a massive, constant, predictable demand.
Right.
So by adding that continuous industrial load, the utility is essentially spreading the grid's fixed infrastructure costs over a vastly larger pool of kilowatt hours sold.
Because the fixed costs don't rise proportionally with the new demand.
Exactly, meaning the theoretical cost per unit of energy drops for everyone else connected to the network.
I mean, the management theory makes sense on a spreadsheet, but I have to push back on the physical reality.
Okay, let's hear it.
Can the California grid, as it stands today, actually handle a 12-gigawatt surge in continuous demand? This is a state that historically faces rolling blackouts during summer heat waves.
Yeah, that's the big question.
It's a grid heavily reliant on renewables, which are inherently intermittent. The sun goes down at 7 p.m., the wind stops blowing, but those AI data centers need power constantly.
And that operational tension is perhaps the most critical bottleneck in the entire AI narrative right now. You simply cannot power a hyperscale data center on intermittent renewables without deploying unprecedented utility-scale battery storage, which the supply chain just can't support yet.
So you need baseload power.
Yes. Power that is always on, regardless of the weather.
Which brings me to a detail buried in the regulatory updates section of this 10Q. Back in April of 2026, the Nuclear Regulatory Commission formally approved a 20-year license renewal for the Diablo Canyon nuclear power plant.
Oh, the history of Diablo Canyon makes that renewal a substantial pivot for the state's energy policy.
It was slated for total decommissioning, wasn't it?
It was. But the legislature and regulators realized that without it, grid reliability during heat waves was compromised. The fact that its operational life has now been extended for 2 more decades is a direct reflection of what you just pointed out.
A need for baseload.
Exactly. Legacy baseload power, specifically nuclear, which operates at a capacity factor of over 90%, is suddenly indispensable for next-gen technology.
That's wild.
Without Diablo Canyon's zero-carbon output, servicing a 12-gigawatt data center pipeline in California would be practically impossible.
It really is a fascinating collision. Mid-20th century infrastructure is suddenly the bottleneck for 21st century tech.
Yeah, and for the retail investor, this whole growth narrative directly supports tangible shareholder returns.
The dividends.
Right. Management used this pipeline visibility to reiterate their dividend strategy. They are targeting a payout ratio of roughly 20% of core earnings by 2028.
So all of it, the data center load, rate-based expansion, O&M discipline, it's all engineered to support consistent dividend growth.
Which is the primary draw for utility investors.
But, and this is a very significant, but it is virtually impossible to analyze a California utility without aggressively pricing in the state's unique risks.
We have to talk about the wildfires.
Yeah, the elephant in the room. The bull case we just laid out is completely tethered to severe historic liabilities.
And any serious analysis of the PCG ticker requires a deep understanding of these accrued liabilities. This earnings report is a stark reminder of that reality.
Give us the specific breakdown from this quarter's filings.
Well, the company reported they have accrued an estimated $2.25 billion in localized losses related to the 2019 through 2021 wildfires.
$2.25 billion.
Yes, and to be clear, that figure includes a fresh $100 million charge added just this quarter.
Ouch.
Plus, their ongoing wildfire fund expenses ticked up to $126 million for the quarter.
Those are hefty numbers draining liquidity.
Mm-hmm.
And it brings us to an impending catalyst every single investor needs to watch. The California legislative session ends on August 31st, 2026.
This is where pure financial analysis intersects heavily with public policy.
Right.
In the presentation, management noted they are, quote, encouraged by policymaker focus on wildfire liability reform.
But there was a warning attached to that, wasn't there?
A very blunt warning. They explicitly stated that without sufficient legislative action on these matters, the company could face persistent financial limitations.
So as financial analysts, let's translate that phrase, when utility management says persistent financial limitations in an SEC filing, what are they signaling to the market?
They are signaling a direct existential threat to their cost of capital.
Explain that.
A utility operates by borrowing massive amounts of money in the debt markets to build infrastructure, right?
Right.
If you have billions of dollars in uncapped wildfire liabilities perpetually hanging over your balance sheet, the credit markets will demand a significantly higher interest rate to lend you money.
The risk premium spikes.
Exactly. If PG&E cannot secure financing on acceptable terms, it threatens their ability to execute that foundational $73 billion capital plan.
Which is the very engine of their earnings growth.
Furthermore, the credit rating agencies are watching Sacramento closely. The quarterly report notes that one major credit agency still rates the utility below investment grade.
And falling below investment grade triggers operational hurdles, doesn't it?
Huge hurdles. It forces the utility to post additional cash collateral just to operate in the wholesale energy markets.
Oh, wow.
Yeah. When they buy power forward to supply customers, counterparties demand cash up front because of the junk credit rating.
So it just traps vital liquidity.
It drains cash that should be funding grid hardening and forces it to sit idle in collateral accounts. It makes every single operation inherently more expensive.
Now, we should be very clear here for you listening. As analysts, we are not taking a side on California politics.
Absolutely not.
We aren't advocating for how the state legislature should handle liability reform. We are simply reporting the reality of the source material.
We just look at the numbers.
Exactly. The regulatory and legislative outcomes in Sacramento are the ultimate discount factor on this stock right now. If the legislature acts to cap or socialize some of this burden, the cost of capital drops.
Liquidity frees up and the bull case has room to run.
But if they don't act, That $73 billion capital plan gets exponentially harder to finance.
It's a binary risk profile. The underlying daily operations are undeniably improving, O&M costs are down, AI demand is robust, but it all exists entirely underneath the shadow of legislative uncertainty.
How wildfire risk is priced into the business model is everything.
Yeah.
So let's bring this all together and summarize the mission of this deep dive.
Go for it.
PG&E is delivering surprisingly strong EPS growth right now, largely through uncompromising cost discipline and rate base expansion, which is offsetting a stagnant top-line revenue.
Yep.
They have a staggering 12-gigawatt data center tailwind at their back, and the state is extending crucial baseload assets like the Diablo Canyon nuclear plant to meet that demand.
But for the retail investor pricing the stock, everything hinges on that late August legislative session.
Exactly. The structural resolution of wildfire liabilities will dictate their cost of capital and their ability to actually build the future they're projecting.
It's your classic regulated utility setup, but just heavily amplified by the modern extremes of AI demand and severe climate liabilities.
Which leaves us with a final provocative thought to mull over. Circling back to that path to flat initiative we discussed.
The residential bill's going down.
Right. If management's math is correct, and every gigawatt of data center demand really does lower everyday residential bills by 1% by absorbing the grid's fixed costs.
Yeah.
Are we entering a strange new era where the tech industry effectively subsidizes the public utility grid for everyday citizens?
It's an interesting shift to think about.
It really is. If you want to stay ahead of the curve on reports just like this and understand the mechanics driving your portfolio, make sure you follow the show for your daily, no-nonsense earnings coverage.